China just hit U.S. exports with a 125% tariff. But that's not the real story. The real story is what they did after, cutting off the dollar, rerouting trade, and making moves so calculated, so quiet, that by the time Washington reacts, it might already be too late. Because this isn't retaliation, it's decoupling. And it's happening faster than anyone in the West is willing to admit. On April 10, 2025, China imposed a crushing tariff on American automobiles, ag-tech machinery, and semiconductor parts, sectors that pumped over $36.4 billion into U.S. exports last year, according to Commerce Department data. This move came just 72 hours after President Trump authorized $88 billion in new tariffs on Chinese EVs and rare earth minerals. Bloomberg analysts called it a precision strike, not just economic pushback, but a strategic message. Wang Yang, senior advisor at Peking University, explained it bluntly. Beijing is targeting high-leverage industries tied to electoral politics. This is no longer defensive, it's surgical. The market reaction was immediate. Tesla halted shipments to China. Deere & Co. lost $2.1 billion in market value in 2 days. U.S. soy futures slipped 4.3% on speculation of broader ag retaliation. But beneath the headlines, something deeper is shifting. China didn't just answer back, it repositioned. This wasn't a trade rebuttal. It was a calculated exit sign. While headlines focus on tariffs, the real shift is structural. According to China's State Administration of Foreign Exchange, Beijing slashed its U.S. Treasury holdings to $668.6 billion in Q1 2025, a 15-year low. But that's only the beginning. The China Construction Bank and ICBC have reportedly halted all new dollar-denominated loan issuances for state-owned projects, pivoting instead to RMB or euro-backed financing. Reuters confirmed this policy shift is part of a broader internal insulation strategy designed to reduce U.S. exposure across trade, banking, and commodities. This is no longer about hedging risk, it's about controlled decoupling. Goldman Sachs' Asia economist Maggie Wei warned that China is engineering a soft retreat from dollar-linked liabilities to preempt future financial sanctions. But if China isn't waiting for the next tariff round, what are they preparing for? On April 11th, China's Ministry of Commerce used a curious phrase in its announcement. Certain U.S. imports were now considered no longer commercially viable. It sounds bureaucratic, but it's calculated. By framing American goods as economically inefficient rather than politically unwanted, Beijing is shielding itself from WTO retaliation while simultaneously directing domestic companies to abandon U.S. suppliers. In practice, this means cutting contracts before Washington even notices. Case in point, BYD dropped a $500 million sensor supply deal with a U.S. firm just days after the statement. According to trade law analyst Henry Gao at Singapore Management University, this phrasing is a regulatory green light for disengagement masked as market rationality. But what happens when market-based decoupling becomes the rule, not the exception? Behind closed doors, some U.S. allies are hedging. In March 2025, Germany's BASF signed a €7.2 billion expansion deal in China's Guangdong province, its largest investment outside Europe, despite U.S. pressure to reduce dependency. Meanwhile, Saudi Arabia finalized a landmark crude oil settlement with China's Sinopec using digital yuan, bypassing dollar invoicing entirely for the first time. According to the Financial Times, France is lobbying for a BRICS EU Observer Forum, while Brazil is pushing to make SIPs interoperable with the Latin American regional payment system. These aren't isolated moves, they're slow pivots. Citibank strategist David Lubin warns, a multipolar trading order is emerging, and Washington is no longer the default center. If allies stop treating U.S. trade policy as their own, how long until China isn't the one on the outside? America's sanctions toolkit is finite, and Beijing knows it. As of April 2025, the U.S. has sanctioned over 640 Chinese entities, according to Treasury Department records. Yet, trade volumes remain resilient. China's exports to ASEAN rose 7.4% year-over-year in Q1, offsetting U.S. losses. Dollar weaponization also appears to be losing bite. The yuan now accounts for 6.3% of global cross-border payments via SWIFT, up from just 2.2% in 2020. Meanwhile, the semiconductor chokehold has begun to erode. Huawei's new 7-nanometer chip, built using a workaround with Chinese lithography tools and Dutch equipment stockpile pre-ban, stunned analysts at Tech Insights. The irony? Sanctions accelerated local innovation. Former U.S. Trade Representative Robert Lighthizer admitted in a Heritage Foundation briefing, "We underestimated their capacity to work around us." If sanctions are backfiring, what's left in the White House arsenal? Wall Street isn't waiting for Washington to blink. It's already pricing in the pain. On April 10th, the Dow plunged 1,000 points, wiping out $520 billion in market value after China's tariff hike hit U.S. agritech, industrial machinery, and EV components. Archer Daniels Midland dropped 11% in 2 days. Deere & Company warned investors that over $3.2 billion in Chinese-bound inventory could face immediate disruption. Meanwhile, Goldman Sachs slashed its Q2 U.S. GDP forecast from 2.3% to 1.5%, citing direct exposure to retaliatory tariffs and indirect drag from export curtailment. Former Treasury Secretary Larry Summers told Bloomberg, "Surveillance. Markets are signaling something the administration hasn't fully processed. This isn't just a trade fight, it's becoming an economic firebreak. But what happens if corporate America demands a truce while Trump's base still wants escalation?" Xi Jinping isn't counting on victory through speed. He's betting on endurance. Since 2021, China has increased domestic chip production by 34% annually, according to the China Semiconductor Industry Association, while slashing U.S. soybean imports from 32 million metric tons in 2018 to just 9.4 million in 2024. Per USDA data. Beijing is also locked in multi-year grain deals with Argentina and Kazakhstan to buffer supply shocks, and ramped up sovereign food reserves by 18% year-over-year. In April, PBOC Governor Pan Gongsheng confirmed that China's foreign reserve portfolio was actively shifting away from dollar-heavy holdings, reinforcing insulation against U.S. financial leverage. Meanwhile, Trump faces an economy where inflation expectations ticked up to 3.1% in April, per the University of Michigan's Consumer Sentiment Survey. As strategist Kevin Rudd put it in Foreign Affairs, Xi's timeline isn't 2025, it's 2050. So the real contest may not be about who strikes harder, but who bleeds slower. American farmers are absorbing the cost of policy without the benefit of relief. According to the American Farm Bureau, over $8.6 billion in agricultural exports to China are at risk in 2025, primarily soybeans, corn, and dairy. Iowa-based Cooperative Landis reported a 37% drop in forward contracts with Chinese buyers this spring. Meanwhile, Walmart CFO John David Rainey warned during the company's April earnings call that tariff-linked input costs were already pushing up shelf prices across core essentials. The Bureau of Labor Statistics confirmed a 0.6% monthly increase in food prices in March alone, driven heavily by import shocks. This isn't theoretical, it's showing up in receipts. This isn't just a rift, it's a redesign. According to the IMF's April 2025 Global Economic Outlook, global trade is splintering into regional spheres of trust, with China leading a bloc that now accounts for 33.6% of global GDP by purchasing power parity, surpassing the G7's 29.9%.